Okay, learning objective 5. We're going to get into some of the details now of this credit market and specifically the banking system, which is interesting and it lends a lot of perspective in terms of financial crises that we've had in the past and potentially the ones we're trying to avert in our current situation with the COVID-19 pandemic. So, in learning objective 5, we're going to talk about what I call the fractional reserve banking or fractional reserve banking system. So here's a question you may not have really considered much, which is that if everyone went to the bank today who has accounts at a bank, if they all went to the bank and said, I want to take my entire account balance out in cash. So I've got my deposit amounts, my balance in my account, and I want to come and take that balance out in cash. Could we all do that? Now, an answer that might surprise you if you haven't learned about the banking system before, the answer is actually no. We couldn't. If everybody came and asked for their deposits back, we couldn't get them because the bank is not able to cover all of those requests. Now, why is that? So here's a simple question, which is how a bank earns profits in the most basic sense. So you have deposits at the bank. Now, some of those may be in checking accounts that don't earn any interest, and that's fine. And some of them are in savings accounts, so they pay some interest on these. To deposit holders. Let's maybe earn a percent or something on your savings account, where you have a certificate of deposit, CD, that earns a particular interest rate. And so the bank is paying people interest. So they just get money and they pay interest. Well, how do they make that work exactly? Well, the bank makes that work by effectively taking your deposits and turning those into what we call assets. Now, the main asset for a bank, I'm just going to simplify here, are loans. So if you go to the bank and get a loan, this was something we started the chapter with. Where does the money come from? The money comes from the deposits of other people at the bank. So you deposit money in the bank, or a lot of people deposit money in the bank, and the bank is going to take those deposits, or some part of them, and they're going to use that money to make loans to other customers. So the bank then earns interest on these loans. And that is how the bank earns a profit. They earn more interest on the loans than they pay you on their deposits. And so that's the fundamental nature of what I call this fractional reserve banking system. And so we're going to kind of dive into some of the details of this and hopefully get a better wrap or understanding on how exactly this works. Now, a few little points of nomenclature here, some words that we're going to need to understand what they mean. So reserves are the cash that the bank has available in order to meet your withdrawal requests. So cash, the bank has what we say on hand. So at the bank, you go to the bank and ask for money. The bank is going to give you some cash. That cash is what we call as the bank's reserves. Now, reserves can also be held at this institution called the Federal Reserve Bank. So it's cash the banks have on hand or on deposit at the Federal Reserve Bank. And we'll learn who they are and why they serve this role. So at the Federal Reserve. Sorry, I didn't, probably can't read that. Or on deposit at the Federal Reserve Bank. Okay, so that's reserves, the cash that the bank has available to give you in the event you come and ask for cash out of your account. Now, what are required reserves? Required reserves are just that. Banks are required to keep some fraction of deposits as reserves. So if you deposit, so that's right now is about 10%, is a pretty standard required reserves. So if you deposit $100 at the bank is only required to keep 10% or $10 of that $100 at the bank in cash in the event that you come to ask for it back. And so that is the nature of this fractional reserve banking system. We only keep a fraction of deposits on hand as reserves. Now, sometimes banks will keep more than the required, and we call those excess reserves. So excess reserves are the actual reserves minus required. So if we do a really simple example here, and we'll say that the UW-Oshkosh Credit Union has, we'll make it simple, $1 million in deposits. And we'll say 150,000 right now in reserves. And 10% is the required reserves that the bank has to have. So we have 1 million in deposits, 150 in reserves. So what's required is the 1 million times 10%, or 100,000. The bank is required to keep $100,000 of the 1 million in deposits on hand as reserves, either at the bank or deposited at the Federal Reserve Bank. So the bank actually has 150,000 in reserves. So 50,000 is excess reserves. My actual reserves, 150, minus what was required, is 50,000 in excess reserves. So we're going to learn a little bit more about the banking system, try to understand why a bank would hold excess reserves, why they wouldn't hold excess reserves, and we'll hopefully make a little bit more sense of these institutions.